You've heard that dividend stocks pay you to invest and index funds just grow over time. But when the years stack up, which one actually builds you more wealth? If you've ever wondered whether to chase income or just trust the market, this video here is going to break down the real numbers, the hidden pitfalls, and what most investors overlook when picking a side. So what really happens if you commit to dividend stocks or index funds for the long haul? Well, the answer might surprise you. So let's start with the S&P 500. Since that's really the gold standard for index investing in the US. So if you'd put $100 into the S&P 500 back in 1957 and let it ride, you'd have about $82,000 by May 2025. And that's not a typo. The average annual return of the S&P since 1957 has been 10.33%. But the ride isn't always smooth, of course, right? There are bull markets, crashes, and pretty much everything in between. But the long-term trend has been up and to the right. But here's the thing, dividends have actually played a huge role in those returns. So according to a white paper from Hartford Funds, 81% of the S&P 500's total return since 1960 has come from reinvested dividends and the power of compounding. In fact, dividend income made up about 33% of the S&P 500's monthly total return between 1926 and 2015. That means if you're reinvesting those dividends instead of spending them, your money can grow a lot faster than just relying on the market's price gains by themselves. So what about dividend-focused strategies? Well, research from Ned Davis Research shows that between 1972 to 2013, companies that consistently increased their dividends posted an average annual return of 10.07%. which is slightly higher than the 9.28% for all dividend-paying stocks. And both of those far exceed non-dividend payers, which only managed 2.34% a year over the same period. RBC Global Asset Management actually found similar results. So from 1986 to 2016, dividend growers delivered compound annual returns of 11.7%, while all dividend payers came in at 9.9%. The takeaway? Companies that steadily raise their dividends tend to reward patient investors in a big way.
But don't forget, past returns aren't future guarantees. Some dividend darlings have cut payouts during tough times.
Yes, Tiara, very true. And if you look at this data alone, it appears that dividends are really the way to go with a slightly higher return. Well, not so fast. So the bigger issue here is that in order to invest in those dividends, you need to pick each and every dividend stock. This could make your investment returns climb even higher if you pick correctly, or be a whole lot lower if you pick incorrectly, which is more than likely. Plus, many people rely on various types of different technical analysis to try to pick the right dividend stocks. But in my opinion, stock technical analysis has serious flaws that barely anyone talks about. And I'm actually going to be breaking all that down in the next video, so make sure that you hit subscribe if you want to see why technical analysis might be leading you straight into a trap. That all said, since picking the right dividend stocks is probably out, right? You'd most likely invest in a fund full of dividend stocks to properly diversify. So let's compare a solid dividend fund versus an index fund historically and see what happens from a performance standpoint. So first up, let's talk about the Vanguard Dividend Growth Fund, or ticker symbol VDIGX. This fund is all about companies with a solid track record of growing their dividends. It's really built for investors who want, steady income with a side of growth. So over the past 30 years, from 1995 to 2025, VDIGX delivered an average annual return of about 8.9% with dividends reinvested. And now let's look at the S&P 500. So we use Vanguard's VOO ETF as our stand-in. This is kind of the ultimate set it and forget it play, right? It's just buy and hold, and you own a slice of 500 of America's biggest companies. So over those same 30 years, VOO clocked in at a return of 10.2% average annual returns with dividends reinvested. Now that may not sound like a huge gap, but over decades, compounding interest turns that difference into a landslide. Now here's where things get real. So if you'd invested $10,000 into each fund in 1995 and reinvested all your dividends on both sides, with VDIGX, which is a dividend fund, your investment would have grown to about $124,000 by 2025. With VOO, that same $10,000 would have exploded to around $209,000. That's an $85,000 difference, which is almost double the return from the index fund. But why is there such a huge gap? Well, it mostly comes down to what's inside of each fund. So dividend funds like VDIGX, they lean heavily on sectors like utilities, consumer staples, and healthcare. These are steady, reliable industries, but they don't usually deliver the kind of explosive growth that you get from tech giants like Apple, Microsoft, or Nvidia. And these are the very companies that have really driven much of the S&P 500's outperformance over the last couple of decades.
True, but not every investor wants explosive growth. Some prioritize less volatility or consistent cash flow.
And definitely a fair point. So if you're, getting close to retirement or maybe in retirement, you may want to focus on preserving your wealth as opposed to growing it with more risk, which makes sense, right? There's also something that's called dividend drag. So companies that pay out higher dividends often reinvest less of that money into their own growth. Meanwhile, the S&P 500s, those tech-heavy winners, right, they're plowing profits right back into innovation, which has supercharged their stock prices if they do it right. And don't forget about fees. So VDIGX, they charge an expense ratio of 0.27%, while VOO is just 0.03%. And just over 30 years, even a small difference in fees can quietly eat away at your returns. But here's one other thing to consider, and it's important. Dividend funds can really shine when the market gets ugly. So for instance, during the 2008 financial crisis, the S&P 500 dropped a brutal 37%, but dividend aristocrat companies with a 25-plus year streak of raising dividends fell only 22%. So what's a big takeaway? Well, if you're looking for maximum long-term growth, the S&P 500 index fund has historically been hard to beat. But if you value steady income and a smoother ride during downturns, a dividend-focused fund can absolutely earn its place in your portfolio. The reality is, if you go the dividend route, you're either going to lose some gains by buying a fund, or you can invest into dividend companies directly, but that's obviously more risky if things go south. But before you pick a side here, there are, a couple more things to consider, like how taxes and fees can really eat into your returns. And trust me, this is where a lot of investors don't pay any attention, and you really need to in order to measure your true investment returns. So let's break down what you need to watch out for next here. Now, before we get started, it's important to note that the tax info that I'm about to go over here in this section, it applies to you if your account is not a retirement account. So in other words, if you have all your investment in an IRA or a 401k, the taxes really won't impact you so long as you don't withdraw money for your own use and just keep reinvesting it till retirement, which, by the way, is exactly what you should do if you were questioning it. So let's start out with taxes on dividends. So if you're collecting dividends from US companies, most of those payouts are considered qualified dividends. That's good news because qualified dividends get taxed at the long-term capital gains rate, which is usually much lower than your regular income tax rate. So for most people, that means you'll either pay 0, 15, or 20% on those dividends, depending on your total income. So for example, if you're single and you make less than $48,350 per year, you might not owe any federal tax on your qualified dividends at all. But if you're in a higher tax bracket, you could pay up to 20%. And there's also an extra 3.8% net investment income tax for high earners. So it pays to know where you stand. So you have to look that up separately. But not all dividends are created equal. So if you get ordinary, which are non-qualified dividends, like those from certain REITs, real estate investment trusts, or if you don't hold the stock long enough, you're taxed at your regular income tax rate, which can be as high as 37%. And that's a big difference. And it's why most investors try to stick with qualified dividends whenever possible.
And this is one of the most overlooked tax traps. Always double check how your dividends are classified.
100% agreed. Most people, they don't even realize this is a thing. So just make sure that you're paying attention. Now, what about index funds? Well, the dividends that you get from index funds are usually qualified too, so the same tax rules apply. Now, if you decide to sell your index fund shares or dividend stock shares, you'll owe capital gains tax on any profit from the shares themselves. So if you held your shares for more than a year, you'll pay the long-term capital gains rate. Sell sooner, and you're looking at a higher short-term rate, which matches your ordinary income tax bracket. And don't forget either about the fees. So index funds are famous for being low cost with expense ratios, sometimes as low as 0.03% per year. That means that if you invest $10,000, you might only pay $3 a year in fees. But those fees are backed into the fund's performance, right? They come out of the fund's assets before you get your returns. So you never really see a separate charge. Now with dividend stocks, you might pay trading commissions if you're buying individual stocks. But I should mention, most major brokers now offer commission-free trading. Still, if you're constantly buying and selling, those costs can really add up over time, so pay attention. But let's make this real here. So what does it actually look like if you put your money to work in each strategy? Okay, so to wrap things up, let's walk through a couple of hypothetical scenarios so you can see how the numbers would play out in the real world. Okay, so picture this, right? You've got $10,000 to invest, and you're deciding between two paths. So on one side, you pick a solid dividend stock with a 3% yield. And on the other, you drop your cash into an S&P 500 index fund, which has historically returned about 10% a year, including dividends, when you reinvest everything over the long run, right? So let's follow Dividend Dave for a second, right? Dave puts his $10,000 into a company that pays a 3% dividend, and he reinvests every payout. In the first year, he gets $300 in dividends. Now, if the stock price doesn't move or he just keeps stacking up those $300 payments, and thanks to reinvesting, his annual payout will slowly grow as he buys more shares. But if the company also grows, even modestly, his returns can compound even faster. So over 20 years, assuming a 3% dividend and 3% price appreciation, Dave could see his $10,000 grow to around $32,000, not counting taxes and fees, which isn't bad for a steady income-focused play where, he wasn't losing sleep when the market had big dips. And next, let's meet index fund Ivy. So Ivy takes her $10,000 and invests it in an S&P 500 index fund and reinvests all the dividends, which again, historically around a 10% annual return. So fast forward 20 years, and Ivy's investment could be worth nearly $67,000, which is more than double Dave's outcome, mainly because Ivy's riding the full growth of the market, not just the steady payouts. But here's the twist to the entire thing and why things could change for either of them drastically. So if the market hits a rough patch and Ivy needs to pull money out during a downturn, she could take a bigger hit than Dave, whose dividend income might keep rolling in even if the stock price wobbles. Now on the flip side, if Dave's company cuts its dividends or stumbles, his safe income could disappear overnight. So what is the real takeaway here, right? What's the right answer? Well, both strategies have their strengths. Dividend stocks can be a great source of steady income and can help cushion the blow during market downturns. Index funds, on the other hand, offer bigger long-term growth potential, especially if you reinvest dividends and let compounding do its thing. The best choice really comes down to your goals, risk tolerance, and whether you value steady cash flow or maximum growth. As for me, I'm all about those long-term returns, and I just don't have enough confidence in myself to individually select 10 to 15 dividend stocks that'll outperform the total index. So I stick mostly to index funds, but of course I do diversify a bit into dividend stocks too, because I do like those steady payments. Now that said, if someone put a gun to my head and told me, you gotta pick 5 dividend stocks to invest in, well, click this video right here to find out which stocks that would be and why I trust them so much.